Tax season is here and our employee of the year Rocket Singh is wondering where he should make investments so that he can save taxes of 45,000 rupees. Yes, he's wondering about where to invest his 1.5 lakh rupees deductions allowed under Section 80C of the Income Tax Act. Now, when he joined his company last year, he filled his Form 12EB and selected old regime and decided to invest 1.5 lakh rupees. But as the year went by, he did not get a chance to do it. And now with only 10 days left, he's running around trying to figure out what to do. So if you are also wondering where you should invest your money in the last minute for the purpose of Section 80C, then do watch this video till the end. Namaste. This is Akriti Agarwal from Wealth Cafe Financial Services and we are here to help you make smarter money decisions. So Rocket Singh is still confused as to where should he park his 1.5 lakh rupees to save taxes. So the first thing any salaried person like Rocket Singh should do is they should go and check their employee provident fund. If your employer is deducting employee provident fund, employee's contribution to the provident fund is allowed as a deduction under Section 80C. So go online, check your passbook and see how much is contributed. Like when Rocket Singh checks, he figures out that 50,000 rupees is already taken care of through EPF. Now he only has to worry about 1 lakh rupees. Now where should he invest 1 lakh rupees? He has so many options and he's confused as to where should he begin. So now we have divided all the options into 3 parts, starting first with the public provident fund, which is your safest, risk-free, tax-free investing option, giving you higher returns, but it has a lock-in period of 15 years. So if you're comfortable with that, then you can go for public provident fund. The second option on the other end of the spectrum is equity linked savings scheme, or commonly known as tax saving mutual funds, where they do have a less lock-in period of 3 years. They are ultimately investing in equities and hence has higher risk. And from our videos and learnings by now, you must know that whenever we advise you to invest in equity, we mean long term. Right? That is how you can manage the risk of investing in equity. And between these two options, you have fixed deposits with a lock-in period of 5 years and national savings certificate issued by post office with a lock-in period of 7 years. Now, of all these options, which one should Rocket Singh opt for is not decided by what he likes or doesn't like, but is always decided by his risk profile. Yes, we go to the fundamental of investment planning even when we are doing tax planning. So when Rocket Singh goes back and checks his risk profile, it comes to growth, which basically means that he must invest 70% of his savings in equity and 30% in debt. Now, of the total 1.5 lakh rupees that he had to invest, 50,000 is already invested in debt, and now balance 1 lakh rupees, which is also 70% of the amount, needs to be invested in equity, and hence Rocket Singh goes ahead and invests that amount in equity linked saving schemes or tax saving mutual funds. Now you must also check your risk profile. Now for instance, if your risk profile comes to balance with a 50-50 ratio in equity and debt, then you must invest 50% in equity, that is 75,000 rupees, balance 75-50 say is already taken care of through EPF, then only 25,000 can either be invested in public provident fund or fixed deposits depending upon the lock-in period you are comfortable with. So with this, your tax planning is done and you know how you need to invest your money to save taxes. But please do note, don't be like Rocket Singh. Don't wait till the end of the year to figure out where to invest and how to invest, because it also gets very difficult to arrange 1.5 lakh rupees in a few days, right? Instead, take the learnings from this video and start a monthly contribution from next year, that is April 2022, so that you don't have to run around. And the second and the most important thing that you must learn is that tax planning is a part of investment planning. Yes, you don't do the other way around. You invest money like you always invest your entire portfolio, and tax saving is one of the benefits that you get out of it. It's not like when you want to eat popcorn, you go and watch a movie, right? You eat a popcorn while you're actually watching a movie because it adds to your pleasure and fun of the movie. Your popcorns are your tax planning. So don't forget, invest keeping in mind the fundamentals of investing and tax planning is one of the benefits you get. If you know someone who is running around trying to figure out where they should invest their money to save taxes, then do share this video with them. And don't forget to like, share and subscribe to our channel. And stay tuned for our video because we are going to bring freshly brewed content for you every Wednesday and Saturday. Until then, don't forget to save hard and invest smart. Thank you.